Okay, an absolute crazy market, obviously, with the Iran-Israel conflict, the whole world's attention on the oil markets, and we dive right into the minutiae of the conflict, the sentiment, the volatility, and the winners and losers as always. So hope you enjoy. Okay, a lot to talk about, Vincent.
They need to talk about the market was getting hotter and hotter, almost as hot as it gets. Had attacks between missile strikes between Iran and Israel, and then on Friday you had US joining in, bombing strategic nuclear sites in Iran, and up until Monday night with the Iranian response, well telegraphed, market 180, geopolitical risk coming off.
So there's so much to dissect. I mean, trading this and feeling this has been awful. And I think one of the things I want to highlight is that being an analyst, no offense, but the difference between being an analyst and a trader in a time like this.
We have no skin in the game.
Well, you're borderline, throwing up at night up until 3 a.m. and then, reading something on LinkedIn where someone's flippantly saying this or that. You're like, as if you fucking knew.
And that's me.
So we made Jorge trade paper barrels every time he says the market's going up or down. He has to buy a Brent or sell a Brent because otherwise there's not skin in the game.
It's all fake, folks. It's all fake.
Well, so far it might get real. But anyway, let's go through like the way the market traded. So what do you want to do? Let's start with volatility, obviously the big one, and we highlighted that last week. It seemed very much this time was massively driven by options. So give the summary and then we'll go over a bit of that.
Sure. So it was a heavily options driven market over the past week. Volatility peaked post even after Trump's exit. The focus was very much on the call options, especially $85 was a particularly sensitive level. A lot of call strikes were bought there. And it was said that if prices surpassed $85, then because a lot of market makers were selling at that level, then that could have triggered some gamma hedging flow, which meant that a lot of the short covering could have led to even higher price action. So instead of that outright, it was mainly focused on this options, and the market was pricing in large volatility and large swings in this price action.
Yeah, there's quite a bit to break down here because we did a session, I think 4 or 5 weeks ago, where we made particular attention to the 95 calls. There was a hedge fund that bought rumored, 100 plus million barrels of the 95 calls in September. And that was we thought that was a volatility play. Volatility at the time was very low and it's kind of a good relative value trade. But someone's got to sell that. The banks sold a lot of that. And then as the market did pick up in volatility, it's very hard for them to just offload volatility. If you want to offload volatility, you need to buy back options off someone. So out there's a huge short. And as this volatility spiked to all the way from the very lows to the very highs, there's a lot of hedging to be done, a lot of mayhem. But then, as you just said, so the talk actually last week was 80 calls. And if it got to 80, I remember the first time this kicked off last week, the first big announcement overnight, it was said, oil went up to, or Brent went up to 77, 76, 77. And the the brokers were saying, if it gets to 80, that's where we got stops. And that's where it could be, very dicey. It came back down, but then we had new escalation and it did get to 80, but the market completely didn't care at 80 and went all the way back down. And retrospectively, people were saying it was actually 85 was the key figure. But I mean, from a statistics point of view, you've got the distribution of calls there, right? So if we just have a quick look at that. That is in the numbers, right?
So on the charts, I suppose last week $85 was what people were talking about because that was where the price was closest to, but the open interest was focused on the $90 and $90 strikes as well as the $100.
To me, that's quite clear. It's still about 90 and even 100 where all the big build up of open interest. I think Mita was saying yesterday, it was the week on week change was 85, right?
Yeah, exactly. Yeah, we had the week on week was in 85, but it was also we saw more just in like in the put options as well. Week on week change from last week. So I suppose all the big changes happened from the week before, but over the past week was more like 85 and 90 coming into focus.
Yeah. Okay. Well, go on.
Let me interject a little bit here. This is the market juice. I was in Singapore about 5-6 weeks ago, and I was talking to an options trader, and he noticed this surge in buying 95 calls. And at the time, he told me they were 14, 15 cents, maybe 16 cents. And he says, do you know who's buying this? Who's causing this market ruckus? And this surge continued for weeks on end of buying 95 calls. And at the time, it looked easily, I don't know, $30 away from where the market was. And then everything goes into the world of speculation. Do they know something? Do they know that something is going to happen? Why are they so certain? Because they keep on buying and buying and buying. I talked to this trader a couple of days ago, yesterday even, and he said these options, they went over $2. So whoever was buying them made more than 10x in their investment. And they were doing it with conviction. So then this leads to another speculation of does the US leak information like naturally or to selective sources? And then they go long on, yes, there will be some military activity that is worth it and the markets are going to spike. And people just become like a beehive. Who knows what, when, and why?
I think even more to that point, before the first announcement of it kicking off, there was 15,000 clip of a call that went through in the evening. Very unusual time, and it was literally the night before. So that speaks more to what you're talking about. I'm not as sure with the one 5 weeks ago because volatility was very low, and our own position was kind of thinking volatility is very low. And naturally, by buying volatility at that time, the risk reward was very good.
Yeah.
So maybe you're right. I'm not sure, but it certainly seemed like the night before. I think for sure, right? We've said a few times on this podcast, politics and economics and markets are becoming completely intertwined.
Yes.
And you were just mentioning before we started, you know, the Trump's saying that this whole time oil was completely off target, right? He was very clear about
that. Yeah, and maybe there's another thing to dwell on. At the time, these options were being bought. The market was heading into the mid 60s and even lower when it hit 59. So it was very unusual for somebody to be buying something that was to the upside when the narrative from the US administration has been keep the oil prices low. So somebody was buying against the overall US administration narrative. But at the same time, you do that if you think there's going to be some kind of war action. But then you need to be very fast on your feet to exit because the narrative from Trump doesn't change. He wants low oil prices, low gasoline, particularly during the summertime. So as all this boom was happening, I was thinking he's going to come in and weigh down.
At some point, right? Yeah, I was thinking he was noticeably, his silence on oil was quite loud, if that makes sense.
Yes.
He's not said anything yet. He's clearly trying to get this done and then turn his focus to it. I completely agree. And I think, but going back to the point, I think this caught everyone by surprise just because of that general sentiment of what you're saying. And I think that what it struck me as last week and this week was that there weren't very many people, if any, apart from this huge fund being long options maybe, who seemed to be taking this bull ride by the horns. I think most people were stopping out, and we've got, I think, some points on that, which contracts, but generally on the outright, there was a lot of stop outs, a lot of options hedging, like we're saying, to manage the selling to funds and people buying volatility. But it also felt that the way people were protecting themselves was buying calls and getting their insurance from way out the money calls, 100, 115. We bought some ourselves, right? Because you're like, look, if this is really going to kick off, we don't really believe this, but we need to have some kind of protection because if it just immediately spikes to 150 or something absolutely crazy, it might make sense to have that risk. So I think the whole market really at once decided the same thing. But it also meant that not many people were actually in the outright trade. I don't think there was many people long flat price. I think they'd done it via the options. It was a very options-driven market, like we're saying. And then Friday night, CME and ICE came out and said 24% increase in call option margin, which says it all, right? There was so much activity in that space. But anyway, I think we summarized that as huge peaks in options, and for a long time, this was very squeaky bum time, as they say. Like it kept being very high volatility, and I think people are very tempted to sell volatility on highs because it rarely lasts. But you know, you just had these attacks going on the weekend. It was very very scary times when the market has been closed overnight and over weekend. And that's when things can gap up, and perfect for options trading, really.
And from the officials' point of view, our premise has been talk the market up, bomb, rinse, repeat. And that has been the narrative through.
Yeah.
You talk it up, you bomb, action happens, then you squeeze everybody who's long, you dump it, and then you repeat the cycle again and again. Now I think we are kind of out of that cycle, but the bombing continues, as we were just talking.
Yeah, so let's keep going through it. So what happened to volumes during this time? I think this would be quite interesting, because I guess my thesis from what I just said, if it's all in the options, then the actual volumes in Brent maybe not that high, but I don't know if that is in the data.
Yeah, completely right. So the volumes in Brent futures, this is what we have on the chart.
On the chart, okay, yeah.
We have on the chart. So that peaked on 13th of June on the Friday during the initial attacks from Israel to Iran. On that day, volumes peaked, but it had come off day on day in the over the past week. So it seems very much to be the case that, yes, the activity was driven by the options. At the same time, outright trading volumes had come off.
So I can't, obviously I'm not trying to put you on the spot, but it'd be interesting to look at previous war events or escalation. And I want, my gut feel is volumes are very high because everyone's trying to get in on the trade. They believe very much. I don't think at any point the consensus market in the industry really believed in this move. That's why it was options and not futures outright. Because if there was a very high conviction bullish move, you get people scrambling over themselves to be long-term long. And I just think that says it all. So let's look at open interest as well.
Yeah, so here we have the open interest. This is also for the SIP 25 Brent contract. So over the past week, even during on the Friday when volume spiked, there was no noticeable increase in the open interest itself, indicating that perhaps the market was maybe more risk off. There was perhaps a lot of people coming in, but also equally people exiting their positions.
Well, it looks like, because we know that there was producer hedging. That's been in the news the last couple of days. Aegis Energy Risk, a big provider of hedging solutions and a platform in the US that brings all the US guys together to trade. They've been hedging a lot. And I know this is Brent we're talking about, not WTI, but I think that possibly it's indicating that actually a lot of longs were, as you say, people were using it as a time to exit and to de-risk their positions. So if you were short and you got producer hedging coming in, it's a good time to basically stop out, right? So that would all make sense. So in general, that paints the picture, I would say, of a very hot market, but in a different way, right? Not in a 2022, even 2023 way where people are gung-ho long. Like the opposite, people are really not wanting to be long, but forced to be protecting themselves in a potentially highly bullish market. It's very unusual. Because
we run up very quickly and briefly above 80, and then the thing kind of exhausted itself. It's like whoever needed to cover, caused this spike, and then it just sells off.
And I think we need to get into why that was, so we could do that now in the next section, but that's a good summary, very, very hot. Okay, now this is the herd mentality. Okay, so Jorge is a newcomer on this podcast. We talk about what's been driving the herd mentality, and of course we know, we don't need to say it. It's been all about the Israel and Iran escalation, the US getting involved. But let's jump straight to the Strait of Hormuz, because that was really what it was all about. In terms of, we've seen endless conflict with Iran, Israel over the past couple of years, Gaza, etc. And yes, this caused volatility, but this was very different because it was all of a sudden a potentially unprecedented scenario of genuinely closing the Straits after being threatening for it since the 1980s. And maybe the last time there was any actual proper intervention was in the 1980s. And all of a sudden saying, okay, after all these threats, they've finally been pushed to actually close the Straits, and it's going to be 150 oil. That was out there a lot. And I think you couldn't stop that narrative brewing. And whilst I think, as I said, the industry might not have properly believed it, a lot of people did. And that's what markets are, right? It's consensus trading. So you were in the camp of never getting closed down.
Correct.
But do you think, even at the time, you felt a bit like, well, maybe you were a bit like, or maybe I shouldn't have been so blasé about it, right? It looked increasing like the parliament did say we're going to close the Straits at one point.
They can say whatever they want. And we had the conversation, you remember. They said this, and they're going to do it. And I said, no. So my position has been steady all throughout, the Strait is
Yeah, but try having a short position on that news, right? So you say, yeah, I believe what you said, so I'm going to be short this market. And Sunday night, you're like,
bomb.
well, no, they said we're going to close the Straits. So you're like, okay, well, fuck, it's over. You know what I mean? Like that's the reality. Like you can say these things with conviction, but having it in the market, worked out well. But don't say you were that confident. Were you that confident?
I was confident. I wrote about it. I put it on my WhatsApp.
You should have put a trade on.
I don't trade.
Okay, sorry.
Because that it starts, confusing the independence.
You can see
maybe
why the market got riled up, though.
No, that I can see, and I could see this difference, and I want to share it with the viewer. They are really old dogs like myself, and even though I don't have the physical experience of being a mariner or a sailor, I do talk to a lot of those folks, and you have a distance in water that is called 25 miles across. And the depth in the navigable area is over 100 meters. And the customary area is 6 kilometers across, 2, 2, and 2. 2 to go, 2 in between, and 2 to come back. But you still have water on the side that you can use. How can you ever close that physically? So physically, you cannot close it.
As a straight barrier, yes.
Yeah,
you can throw missiles.
Yes, you can do that. And then you have to go through the game theory of why you would do that. So if you're Iran, what benefit do you have by disturbing the flow of oil? Number one, you cut any revenue you have in. 2, you harm your biggest customer, which is China. Your biggest customer is angry at you, and on a relative basis, China weakens relative to the US. So you actually help your enemy in doing that.
You say game theory, and of course they needed to use leverage, right? If Iran had been so weakened in this scenario, you're forcing them to use what they've really got. So let's not say, like, if you push someone to desperation, you push them into a corner, do they even care? If it's about survival.
Yeah, one of my physical friends is the Samsung option, where essentially you pull the temple down on yourself. But that would anger Saudi Arabia, Kuwait,
yes, of course,
Qatar,
it would anger them, but you've got no choice.
Absolutely,
you're on the last legs, right?
Everybody.
Yeah,
and the impact of that is the damage again to the US. Mm-hmm. So then, on a game theory basis, and this is what happened, the US has to step in and tell Israel, don't bomb Khark Island. Because otherwise the other side exercises the sanction option and the whole thing shuts down, and then I get thrown out of office.
It was tight. And I think what we found really interesting on Sunday night was the Polymarket. I mean, that's become a really interesting concept. People putting their money where their mouth is on these things. So have you got the Polymarket snapshot?
Yeah, well, we do. Yeah, it's on a screen.
So this was, as you can see, it peaked up to 60%. I think peak on Sunday. This is obviously after the Parliament said we voted to do it. And it's really interesting looking at the comments. Because
and that's maybe the time you and I were talking,
this
right?
We're talking. And look, it started to weaken. And again, to your point, does someone know something we don't?
Yeah.
And in the comments section, it's quite interesting. Someone was saying, I think it's this Patroclus guy or whatever.
Yeah, it's like, yo, this is so funny. I'm quoting, yo, this is so funny. I'm literally in the Strait right now on a condensate tanker.
Yeah,
we're sailing good homies.
He was trolling the whole night. He was saying things like, oh, there's been a massive disturbing announcement. And I was like, what's going on? And then he would say, we've been told to turn the music down and stuff like this. So he felt very, very confident, weirdly confident, right? He obviously knew what was going on. I guess.
That's not me, by the way.
Yeah. I mean, you just don't know what was really going on. But it was interesting that it was declining all from 60%, ratchet down. And actually, at some point in the comment section, they're saying, it has been closed. We're hearing all this news. We're hearing the GPS signals have been jammed. We're hearing all this stuff. And this leads me to my other point, which is, when you were reading all about it, on X in particular, but also LinkedIn, there were quite a few people relishing in this. Like, this is going to happen, straight to close. And I got, it almost looked like they were enjoying it. And that started to piss me off, actually. Like, you want to know the real information, what's really going on here. Okay, GPS signals, whatever. But it's like, just people are basically long and they're gambling on these things. And then they're sending out information to get people
They
riled
want to
up.
fluff it up.
Fucking real people's lives, real situation. That's a global economy gone. Like that, I didn't like that dialogue, really. I mean, of course, do what you want to do. But I think it just got a bit like vitriol, and those kind of things is when it can get quite nasty, and people do react to spurious information, right?
And there are some real events, like when the two ships collided and had the fire. And then they're going, oh, this is it. This is a signal of what is going on. And if you're in the physical market, ships are like cars. They have collisions all the time.
Yeah.
Maybe we don't want to hear that. Maybe we don't follow that. But they have
normal events are
correct. They're magnified.
You'll know this better than me. No offense, you're a bit older than me. And do you remember in the Cold War crisis? I just can't remember the exact details, but I don't know if there was a Russian submarine or a commander or captain was basically told that if in the peak Cuban Missile Crisis, I think around then, if there is a signal of a missile being sent from the US, press the nukes and do it. And it happened. There was a signal on their computers or something like that there had been a missile, and he was with all intents and purposes, like in terms of the rules and the doctrine, he was meant to press the button and bomb, and he decided against it.
Meme.
No, but seriously,
kill my family, kill the world.
No, but seriously, he was meant to do it.
Yeah.
And he didn't do it. And I guess you can read about why, I don't know, maybe he was just like, I'm not going to press this button if I don't 100% know or something like that, maybe.
Correct.
But my point is, that's the kind of shit that happens when you start doing this vitriol on social media, LinkedIn. You're going to cause people to get very nervous and potentially do something absolutely reckless.
Yeah, I think what has changed is now everybody has a platform. Everybody can say whatever they want, and there are various different levels of knowledge, and your book comes through. So I think we need to keep ourselves cool, observe, not act in rashness, right? But some things are physically impossible. And that was my premise from the very beginning. You cannot close the strait.
In terms of like, I think, I know what you mean, like a physical barrier, but you can disrupt like the Houthis did in the Red Sea.
Yeah.
And there are things you can do. So it was legitimate volatility, but I guess you can forgive people for being very unsure what's going to happen. But so much so that sometimes, or a lot of the time, the market is a reflection of basically people's psychology. And for us to go in on a Sunday night, waiting for the market open, and it to open $3 higher and then basically crash all the way back down throughout the day, even though people say it was about the ceasefire, the Brent price was going down before the ceasefire.
Yes.
And on the Friday, the consensus was, no, sorry, not consensus. The talk from us and from, like, I think we heard some trade houses who were thinking the same way. As soon as the US bomb the, if they do bomb Fordo, whatever it's called, the nuclear site, it's kind of over. It's not over. Obviously, there's going to be some crap around it, but that's really taken out the leverage in the game, and that's what the US wanted to do. And you'll see some crap, but really that's their job done. That did prove to be the case, but Jesus, it wasn't exactly a comfortable ride.
Talk the market up, bomb, rinse, repeat.
Fine. But as in, like, what I'm saying is that what on the open, what I think it showed was people had done all their possible basic protection, insured against this possible huge crisis with buying the options, like we said, de-risk themselves, stop outs everywhere on gasoline versus heating oil, on the outright price, on Brent spreads, on everything, and just let it be. And that is the best explanation I can give for why it was such a muted reaction and then sold off, because no one was invested. They were insured, but they weren't invested, and they weren't looking to take on the market. They were taking a breath and let's see what happens.
And then there is an after effect. Because I live in Singapore, I talked to some of the customers that were a little nervous. They were buying things. And they're also saying, we overbought crude. And if nothing happens, it's a cycle, we're going to need to sell it back out again. So some of those premiums, and this is something that I was thinking overnight, right, is all those deltas, the premiums in Dubai, the premiums in Brent, they may get hit hard in the next couple of weeks, because if
they're
you're
already getting hit right now. You're absolutely right.
If you're long, you're going to need to get out of those positions because you don't need the oil anymore. So
I think what you're saying, which is our next section, we'll cover this, is what the physical guys were essentially doing. This is our official section, and what the implications of that was. So we'll do that in a second. But I guess we've just got to comment quickly on the herd mentality going forward. Now, I think it's fair to say the market gave a kind of risk-off mentality as of last night and this morning. There was a bit of chat about ceasefires. There was a ceasefire, then there wasn't, as in there's still bombs, and then there's been reaffirmed this morning. I guess that's still slightly up in the air, but generally speaking, I think people are wanting to move away from this. So I think we've got to talk about OPEC quickly. Again, I think that's coming back in. I think Saudis and the ADNOC certainly showed their hand in this crisis. And I think there was talks not long ago of another increase next month. So I think just before we talk about it, I think it's fair to say the herd mentality is going to be shifting towards OPEC again. So that's that. So now let's cross to the officials. So usually we go to Ed and Will. They're in a room, but we're going to go to you, Jorge, as the managing director of the officials. So please, let's talk about the physical premiums going forward. But I think to start with, we've got to bring up the ADNOC scenario, right?
Oh yeah. We just recently hired another addition to staff to the officials, Spiros. Very nice young man, and we are introducing him to the industry and to the market. And one of the things I was telling him is that he will never be bored, because this is an industry that, I use this word, what can I say? It's an angry industry. I mean, how many people get killed over oil?
Yep.
How many bombs happen?
All the money, all the government situations, the fighting. I know what you mean. Absolutely. Yeah.
It's an angry thing.
Yeah.
And it's manifested in many levels, right? There are lawsuits. If even to us, if we raise our hand and we say something that the industry thinks we shouldn't say, then they come at us. Of course, we never give up. But there are so many interesting things happening, and it's always about money. And we have been following, and every week there's something new. We have been following ADNOC's actions because the oil price, and they have a system where they price their oil on an M+2 basis. So the oil that I'm pricing this month is for oil that I will deliver in 2 months from now. And actually, the system I'm using may lead to a very low number or a very high number in relation to what actually happens next month and the month after. So they priced the previous month oil in the low 60s. And then they saw the oil price shooting up to 75, even to 80. So in theory, you have a $15 loss between what you marked it at and what the market is doing. And I met them, of course, and they were very angry, thinking that the traders are manipulating the flat price retrospectively.
Sold it too low.
Yeah, and therefore they're pricing out their crude too low, and they want to recover that money.
So the first thing, because I know where you're going, but the first thing was about their flagship grade Murban, right? This is a high quality crude, and it was getting sold cheaper than Al Shaheen, cheaper than Armani group, and they were frustrated by that because it's a higher value crude. But that was just free market. It's their flagship crude.
Yeah.
And then not only that, the Dubai benchmark was using the cheapest grade, which was Murban. And I think that people were then saying, well, if I can't get rid of Murban in the open market, I'll use the physically delivered contract, which is the Murban IFAD kind of ICE partnership. And people were selling into that, and it was further depressing prices.
Correct.
So they then said, right, we're going to bring in Murban internally to our refiners, and we're going to export more Al Shaheen. So that naturally...
Upper Zakum.
Sorry, Upper Zakum. That naturally gave a lift to Murban versus Dubai.
Yeah, inverted the spread back out, and that's fair game.
That's fair game.
And those are cents. Call it 10 cents, 20 cents, 30 cents, even 50 cents reversal. That's market. But then what they did next is they allocated what they were supposed to deliver in the contracts. And every contract physically has a little bit of what is called the optol. You have a minimum
operational tolerance, yeah.
You have a minimum and a maximum that you can deliver because maybe the host disconnected too early or too late or something, right? You have to allow for a little bit. But
whose option? It depends on, sometimes it's the buyer's option and sometimes it's the seller's option. And clearly in this scenario, it's the seller's option.
Yeah, and this operational tolerance is actually a commercial tolerance, but it's called operational.
Yeah.
Because if you have the option to close the hose, either as a receiver or as a giver.
Well, it's a well-known thing, and it's how these physical trade houses make a lot of money. It's why they love volatility, because essentially, if they're buying it at one price and the price goes on, a month or two later to be a lot higher, if they
you
bought
pump in a lot.
well, they've bought a crude that's loading in 2 months, and from the day they bought it, before it gets to the end of that 2 months, flat price has risen. They can maximize if they're the buyer, right? They can buy more at that lower price, and they've got real links to the derivative market from a physical contract, and that's the interplay between physical contracts and derivatives is how these guys make so much money. Definitely not well understood out there.
Yeah, no.
They're not geniuses calling the market right, and they've got all these clever contracts, and they use the derivative market to monetize the volatility. And anyway, but it could sometimes work the other way. Like the producer this time was minimizing.
So the contract then has these tolerances, which are commercial and allow, and depending on the contract can be 1%, 5%. If you're very lucky, you have a 10% operational tolerance, right? But normally it's
a typical cargo like 500,000 barrels, 10%, 50,000 barrels of it can be either maximized or minimized. Yeah,
correct. But typically it's between 1 and 5. But then ADNOC decreased the delivery because they were delivering very cheap barrels, right, at 62 in a 75 market. Then they minimized the delivery of cargoes by 20%. This is unprecedented. And this is
sometimes more, right? It was up to like 40%, I thought.
They said, but the vast majority of the cargoes were at 20%.
20%, yeah.
And I just got some text messages this morning with people complaining that they lost $12 a barrel in the mishedge. Yeah. $12 a barrel.
So if it's on one cargo, that's 500,000 barrels. So 20% would be 100,000 barrels. So you meant to be getting 500. You're now only getting 400. And you would have hedged on the basis of 500. So that hedge means you're over hedged by 100,000 barrels. You've sold flat price. It's gone up $15, you're saying?
Yeah, 12 to 15.
So let's say $12 on 100,000 barrels. That's $1.2 million on one cargo.
On one cargo, and you're buying VLCCs. So actually buying 2 million barrels.
2 million. So times it by 4. So for a VLCC, you're looking at $4.8 million per VLCC.
Per VLCC.
So how much physical do you think was impacted?
Between 3 and 4 million barrels.
Okay. So.
But then there are chains all across, right?
Yeah.
I under-delivered to you, you under-delivered to him, and then somebody can sue you, and then you sue me, and I sue him because I bought from him. And it becomes a mess. And I was talking also to some people related to IFAD, because if I am expected to receive from you 500,000 barrels, and I am selling that volume into IFAD, now I am long from you and short into IFAD. But when the delivery time comes, you only gave me 400. Then I need to buy back another 100,000 from IFAD, never mind the hedges.
Yeah.
So this can actually screw up the IFAD mechanism, because in futures you have no operational tolerance.
Right.
You bought 1,000 barrels, you sell back 1,000 barrels. There is no uptol whatsoever. So it is very critical then that the system from the route, which is ADNOC delivering the Murban, to the buyer that buys it in IFAD and receives the barrels, that the volume is the same. Otherwise, the system breaks down. And I think ADNOC has been so angry at the traders that they're sorting one problem, the flat price, but they're not seeing the implications of sorting this problem causes then to their flagship program of turning Murban into a futures contract similar to Brent. This essentially shoots it in the head.
But, in these scenarios, I mean, as you said, oil's a very angry industry. Traders are going to say, that's what's going to happen. That's the game, right? I mean, are they going to complain that much? They might make a bit of noise, but it's going to move on. They're going to trade with ADNOC as normal. Nothing's going to change.
Yeah, somebody was telling me that similar things have happened in the cocoa market.
Right.
And some people were caught short, and Ghana, who is the main supplier of cocoa, just changed the terms and screwed up everybody. People are getting fired. And you can sue them back, but Ghana is the producer of cocoa. Mm-hmm. If you get in the bad books with them, you get no cocoa.
Yeah.
So to your point, and they're going to resolve this, but some trust and integrity in the system has been lost.
And as someone who was managing the benchmarks as, your entire living, right? I mean, what would you be doing in this scenario for the Dubai benchmark if it was I mean, does it make any difference to the pricing right now? Or if now, let's say next month's delivery, they've got all this oil, they're going to sell it back?
This would be a very serious, almost existential question, because there's not enough volume to support the benchmark. And if I were leading this effort, ADNOC deserves to be removed from the pricing process. But that's almost like cutting your own legs, right? Because you would remove Upper Sacom and you would remove Murban. So there would need to be serious discussions with ADNOC. Are you dependable? If you cannot give that commitment that you're dependable, you need to be removed. And you need to then go to the next entity that can fill in that position. In the way I see that section of the world, Saudi Arabia wants to expand its markets and occupy a different role. And maybe this just opened the door for them if they want to step in, right?
Yeah. And I think what was also incredibly interesting throughout this whole crisis was that if you had a position on Brent versus Dubai, which I did, it was very like, what is going to happen? I mean, unprecedented.
Yes.
And we were debating it. In some circumstances, you could take the obvious binary answer, which ChatGPT will give you, which is, that the Straits get complicated, the Middle East gets some kind of friction, it reduces the impact of Middle Eastern crude into the market, therefore Dubai gets stronger versus Brent. So generally speaking, you should sell Brent Dubai, but no one was selling Brent Dubai. And on the flip side, when things calmed down, Brent Dubai didn't move either. So it was just a scenario of, I think people were just absolutely not willing to go anywhere near that differential, buying or selling. And I think the rumors are that people lost a lot of money earlier on in the year from a trade house perspective.
Yeah.
I think it was so nuanced. It just wasn't clear what could happen, because like you said, in the pricing mechanism, that's when it's most important. And that's what you're trading. You're not trading a contract. This is what people always need to remember, right? You're trading the pricing methodology. You're not trading global crude. So the pricing methodology, you've got to think really hard. What if the Straits do close? I know you're saying it never would, but if there was some kind of disruption, well, all of the oil is being priced on the left side of the Straits, right? As in down by Abu Dhabi and those areas. And yes, the methodology is it needs to be free flowing oil. But, for all intents and purposes, it is free flowing around that area, but it can't get out of the Straits, let's just say. So what happens? Does the Dubai benchmark go up? Well, no, it could actually be in a glut. It could go massively down. So maybe Brent Dubai is a buy. And you shouldn't. Anyway, we weren't clear and no one seemed clear and nothing's happened. But I just mean, it just emphasizes the point that even the industry who are, some of these trade houses are complete experts, like the highest experts in trading these mechanisms and the impact of these mechanisms. There was a very risk-off approach to that because it's unprecedented.
Because you need to understand the methodology. As you said, you're not trading the oil.
But they might understand the methodology, but they don't know what's going to happen, right? And I'm sure if you were working there, you would have begun getting calls going, so what happens if the Straits close? What are you
getting calls.
But is it fair to say you weren't sure either? Like, what?
No. I'm very sure. How the system I built, right?
Okay.
So, if there were to be a hypothetical closure of the strait, which, as I said, it cannot happen, right? But let's assume it is hypothetical.
Would that have been your callback? It's not going to happen. Don't ask me.
Don't worry about it.
You've got to entertain it.
It's not going to happen.
Yeah.
But if it were to close, then the only tradable crude is the one outside the strait. And that means Murban or Upper Sacom coming out of
the only tradable one. Why? Because the delivery is in those ports.
No, but I wrote the methodology. So
because of the free flowing part.
Correct. It has to be merchantable.
Okay, fine.
And if something cannot move out and be safe, then it's not merchantable.
Okay.
So the only merchantable crude that remains is the Omani crude and the one that comes out of Abu Dhabi through the Fujairah terminal, through the pipeline. And that's Murban, Upper Sacom, but it's not the amounts that flow on the other side. So there will be a shortage. And that would cause the price of the merchantable 2 grades or 3 grades to shoot up.
Okay, fine. And then, okay, fine, that happens. But the other argument is it's hard because Brent Dubai finds its way in most wars or conflicts to rise anyway, because even if it's in the region, people go after the substitute grades.
Yes.
And they get very tight. So it's actually a very hard dynamic to trade. But anyway, that's very clear.
And by the way, this is what happened. People started to buy North Sea and Midland because if they're going to lose the Gulf, they want to have
So
the
this is what I
alternative.
wanted to pass you next. From your conversations with people, I think the trade had seemed like all this stuff was kicking off. So the oil traders started to buy physical crude, right? They started to buy physical crude and go, okay, well, obviously we're riding this up on the derivative basis. We're going to buy deferred loading physical. That's still got time to load. So it's still linked to the derivative price. And you were saying they're kind of waiting to offload it, which probably would have exacerbated the move down, because even though we were saying people weren't invested in the outright price, if they bought it on a physical basis and left themselves unhedged, then as this de-escalates, they're not going to immediately be able to sell the crude. So they've got to actually sell the derivatives to hedge. And that could have exacerbated this move down from 80 all the way down to like 69 or whatever. That's fair to say?
Yeah, I think we still need to at least see two impacts. Number one, a lot of people were long the intermonth, the M1 versus 2. And that spread, I think, peaked at $4.
Yeah, but that was, we talked about like a glitch.
It was a glitch,
Yeah.
but it was around 180 steadily without the glitch. Then it came down to 150. Last night came down to 130. I think this morning is around 120.
Well, no, it got down to 77, 75-ish.
okay.
And I think it's back up to 90-ish or 101 now. Maybe, yeah.
And people need to roll it.
Yeah.
Because they're holding something long that they don't need, right?
Yeah.
So we were talking this morning, could this go negative? That would be massive, right? But if too many weak hands are holding that front oil, it'll be sold off until it clears and the contract is expiring. So we have about
You have
3
to get
more
the out.
days.
You have to get
You
somewhere
have
to get rid of
out
it. Yeah,
now.
yeah.
So that's one. That's one impact that I think hasn't fully played out. And the other is the extra physical that the Indians and the Asians bought ahead of this mess in
Just
the
in
Gulf.
case, right?
Just in case, the insurance extra barrels. And selling a physical cargo is not the same as just exiting a spread, right? You need to find a customer, negotiate the premiums and differentials. It's a slow process. It's not something you accomplish in a day. And I think that will play out over the next 2 to 3 weeks as people wind that
Well,
out.
this morning, crude traders were saying the dated market is getting absolutely trashed because refiners were buying buy side hedging all the way up at the highs. And they just, as you say, they need to just offload now, and they probably don't want to put it in storage in a backwardated market. So they're just flooding it back on, or at least sell side hedging to protect what they've bought. So makes all sense. Thank you very much for that, Jorge. So let's move on now to more of the positioning again and how people have fared. This is the hedge fund watch.
Okay.
For fuck's sake.
What happened?
It violated the ceasefire.
The teams.
Who violated the ceasefire? So what is the price now?
They breached the ceasefire, but it's not confirmed yet. And Giovanni just said that.
Looking at look at the traders chat. Israel Cat says instructed IDF to respond forcibly to Iran. Iran denies firing missiles at Israel after ceasefire.
All right, let's quickly talk about that. Just been told about the ceasefire. I think, again, I'm looking behind live. This is the distillate crack. It's unchanged. We don't have flat price up here. Well, you've got, it's too hard to tell. Maybe I can go and check. But you just said in the trader chat, people are saying market's not reacting. It is a little bit like what we just said earlier. There's going to be some noise now, but the bulk of the issue of the Straits of Hormuz and all that fear
It's over.
is over. So this is tit for tat stuff, going back to maybe exactly what it was pre-environment. But anyway.
For tat, maybe a bit of market headline fatigue as well.
Yeah.
Back to like what the market expects normally.
Yeah. All right, well, we'll move on then. So, hedge fund watch.
Hedge fund watch. So the main headline was we saw was hedge funds leverage was reaching a 5-year high, and since the start of the year they have increased their exposure, going long in energy stocks, in insurance, and buying banks and trading companies. That's what Goldman Sachs data showed. Basically hedge funds up their short positions in Asia whilst being modestly long on North American stocks. So
it was like a war event trade style basket portfolio, and that's been unwound right now, I would imagine.
potentially, I suppose after events of last couple of days, maybe there's more de-risking, more liquidation. But
So you think buying defense stocks, but selling general markets in Asia Yeah.
Asia's Europe, yeah, still more bullish on North American stocks.
Yeah. But again, buying the outright price, I think hedge funds as well, they were buying a lot of options, right? That was indications we had. But then the CTAs,
Yeah.
that's a big shift, right? I mean, that's a core flow in the market.
Yeah, CTAs were quite a big one actually, and it seems like they were also one of the main drivers of the rallies over the past 2 weeks. So we have the charts. As you see on the right, the net positioning has been increasing to nearly 5-month highs, highest level since January. And initially, they positions came up from a place of being very much net short. So initially, there were CDA short covering flows, but that translated into more bullish in the money flows over the past week.
What's interesting about this, so is this 20 million barrels for every contract? They're very aligned, which is unusual as well.
I suppose it's because they trade on a flat price basis between the oil futures benchmarks.
Yeah.
So we're looking at it's
But
just
as you
not
can
just
see in
Brent,
previous times, they're very long RBOB, and actually they have been long RBOB against being short the rest of them, which is really interesting that they all just completely aligned, which shows you the binary outcome of the escalation. So this, as it goes down, probably starts the divorce again, because gasoline is actually holding up quite nicely. Distillates got way overbought, I think. We know there was big stop outs from hedge funds, right? There's a big gasoline versus heating oil, as they say, gas to heat. So that's in Europe as well, with EBOB versus gas oil. A lot of stopping out. So that had the impact of people selling down gasoline, and obviously the crack in distillates was going very strong, but it really peaked. And even before the ceasefire was announced or things started to calm down, the price was really starting to come off after a big volatility spike, which suggests it was the end of the stop out. You know, the gas oil cracks went from 15, 16 all the way up to 26, and now they're back off, and that, 1968 on the prompt there. Sorry, but the CTAs, adding that weight, I mean, that wouldn't have helped, right? As things are escalating, the CTAs are obviously buying as well, and that caused a big momentum shift. But on the flip side, they're now the CTAs are probably aggressively reversing that as well. So you can't imagine CTAs are making much money here.
Well, I guess if they're trading based on momentum, they'll be trend following, right? So as Brent, as oil futures initially rallied, they would have joined in, initially covering their shorts, but then adding length.
But they're quite slow. It's not so high frequency, right? It's we're talking like 200-day moving averages and this kind of stuff, right? And so I doubt they were able to sell much last night, like in this $10 sell-off. It's not a CTA to rush in and sell unless there's a discretionary shift.
Potentially, potentially a bit of both. Maybe not as much CDA flows as we were expecting, but we'll have to see. But there definitely would have been chances to take profit over like last night's events.
If it was discretionary. But the whole point of a CTA is to objectively track momentum indicators, and they like a long, slow trend up or down, right? And this is the opposite of that. This is choppy volatility, and they've kind of stopped out on the way up, and now they're going to have to stop down on the way down. So
yeah, I suppose I see what you mean. Over the rally of the last 1.5 weeks, it was initially a big spike, but then it was a gradual move upwards up to the high 70s, even 80. But it was
increasing their length, right?
Increasing their length, but last
bang.
night's sell-off was pretty sudden, so maybe they haven't had enough time. It would have had maybe some took off profit, but yeah, I suppose there were some stop outs along the way as well.
Yeah. Just to show off Flux a bit, so we've got the news feed on the right, which has got a bunch of tweets from X coming through. So you've got Israel Defense Minister say he ordered the IDF to retaliate against regime targets in the heart of Tehran. But the markets are staying calm and oil price drops. So yes, reiterating kind of what we said, just scrapping again.
What is the commercial damage to some of these CTS or hedge funds? Because it's a 15% reversal following a 15% up move, right? So you can get caught wrong both ways and maybe exit the stage. But I haven't heard anybody getting hurt badly in this.
Well, it's
move.
quite well modeled, and I think they do obviously have drawdowns, but it's within a percentage limit, even based on the historicals. This is not an unprecedented move in flat
It
prices.
just was very fast.
It's
right?
just very fast. Yeah. And I don't think they've done great, but I don't think it would be down 50% type stuff. You know, maybe down 5-10%, that kind of stuff if it was to materialize. But you won't know until next quarter, really. And still got the rest of the year. Maybe they've made a lot of money up until now. So, okay. Anything else on the hedge fund watch? I guess we already mentioned a huge hedge fund piling in on the 95 calls. They've obviously done well. And anything else? Or
Yeah, just on the money manager perspective. So as we would expect, they added a lot of net length over the past week, perhaps due to this event risk, due to all of this geopolitical stuff. So especially in Brent futures, net length increasing 6 weeks in a row. But interestingly, in gas oil futures, that the rally was driven a lot by stop outs, especially short positions decreasing. The amount of short positions coming off was accelerating week on week. So the first week, 5%, the next week, 15%, and the past week's ice cot data was showing 35% decrease week on week. That's in ice gas oil. So a lot of that was driven by short covering more so
on the gasoline's heating oil would be what I predict on that. So that's very interesting. Okay.
It's a spoiler for Widowmaker.
Oh, sorry. Yeah. All right. Well, now let's move to the refiners. This is the crack spread Chronicles. Okay, so obviously a big week for refiners as well, because with the huge spike, so moved the cracks, right? I mean, we had a big rally in gas oil like we just talked about. RBOB or gasoline generally limped up, even though relative to gasoline it was weak. And you saw the outright margins just again rally after, you know, us talking so heavily about them being too high ultimately. Refiners making so many profits, utilization incredibly high in the US. They got another uplift. And that one thing I'll immediately say is we got a lot of visibility at Onyx in refinery margin hedging. There was an incredible amount of hedging. And I think it made a lot of sense that it was concentrated in gas oil. They were seeing these stop outs. I think the economics suggests that, you know, gas oil is way overvalued from a refiner yield perspective. So they were more than happy to lock it in. So it's great news for the refiners. They're going to be running highly profitable for the rest of the year, at least with those hedges. But sorry, don't want to steal your thunder.
No, that's 100%. There was the recent events provided a great opportunity because of the forward curve being shifted higher. We saw refinery margins on an outright basis. They increased over the week, despite flat price increases. That's because of how strong the gas oil cracks were. That the increases in gas oil drove much of the increase in margins, but you also saw a bit of strength in fuel oil as well. So on the screen here with the two charts, you could see Asian and European refinery margins. The dark line is this week's margin versus the light blue line that was last week. So you could see there was a huge shift upwards, which meant that refiners looking at the forward curve, it would show that they'd be much more profitable. And so it's unsurprising to see all of these new hedging flows come in. And more specifically, we saw a lot of distillate cracks hedging. So 7 ppm versus the Dubai crack or jet fuel hedging from sellers as well, from refineries.
So generally speaking, across the curve into the future, so not just the rest of the year, going into next year. So it's good news for refiners. And I think hedges in general, we said earlier on in the year, when we had the initial flat price dump with the Trump situation, we had an incredible amount of new open interest coming from hedges in jet fuel and essentially all the consumers, shippers and jet fuel in particular. And now we've seen the complete reverse. We had an incredible amount of US producer hedging, Brent hedging for European producers. So I think producers really nailed it, and so did refiners. So they didn't sit on the sidelines. They didn't get carried away with this move, thinking it was going to last forever. They really, really locked it in. So great job for them. It's a great year for hedging. It says kind of speaks to the function of the derivative market. This is exactly what it's here for. So yeah. And where does that leave fuel? Fuel's been the hot topic this year as well. How did fuel react?
I think fuel initially last week, the high.
We've actually got it here. This is the prompt crack, right?
Was the prompt
European crack. We actually came off then in this crisis. Nothing too volatile, but down like $1.
Yeah, initially last week did rally off. Last Monday there was that headline out of Egypt how they would need to be requiring more high sulfur fuel oil for the summer power generation demand because they usually imports natural gas from Israel. but then Israel's production was shut down for very, very briefly. So there was a short-term market panic. There was a lot of short covering flows that drove rallies in high sulfur fuel oil cracks and spreads. But interesting enough, during last week, there was a lot of volatility in the 380 East-West difference between Asia and European high sulfur fuel that came down from around $20 to below zero. So it just shows an insane amount of volatility. Initially, the market bought into the news, but then sold it very quickly as they realized that the shortage wasn't much, didn't turn out to be something substantial.
I think that's incredibly significant because the rally had come from the east, and for the east versus west to go flat, is the indication that this is effectively they've given up on that story, or at least relative to Europe. It's just a global high sulfur fuel market reflection now, which is still very high. But that's quite interesting. It's almost like it's had its last possible bullish news and maybe calmed down now.
Yeah, that was perhaps the last possible bullish news and really gave away to a lot of selling flows afterwards. The fuel traders are saying that may have been the one thing that was holding up the market before all this bearish momentum came in. I believe in the podcast in the last couple of weeks, we were all pretty bearish in fuel oil, and suppose that was the last thing before the market kind of capitulated.
Yeah, I still think we need to look, given this is about refiners, what do they run now? And I think if they've hedged a lot and gasol's had another spike and fuel obviously has been so strong, they're still geared towards heavy sulfur crudes. That's very good news for the Middle Easterns, for the Saudi Arabians, for their allocations. They should still be strong. They should still be great for market share. So we go into the next OPEC meeting, Jorge. I mean, what are you expecting? More of the same, an increase on paper and high allocations?
Well, the OPEC meetings is an exercise in fakery, because they say we're producing this, but they're actually producing that. And the quota needs to be steadily moved up to reality, because nobody can do any analysis. I read what the banks write, and they're assuming the numbers are correct, the numbers generated by IEA or OPEC. So there is a discontinuity between really reality and narrative. And I think steadily OPEC is realizing that it doesn't help them, because you have the market correction when the market is long. So you might as well move up the fake quotas to reality, and then the market is what the market is. But that also points to the internal frictions between Saudi Arabia and the UAE, who is the overproducer by large. Is the
Not
main,
recently.
No, they still are. They still are very significant
with their operational tolerance stuff.
Yeah, what I understand they're doing is they're putting it in tank to release it the next month, but the production still remains at the level they do. So OPEC also does some very good things. They were a market stabilizer as the market was running up, and saying that supply was healthy. So they also have another role, which is about not destroying demand through a very high price. So I think we're here in a band where OPEC knows that prices shouldn't go to 80, 90, 100, even though they want to. And maybe they want the 80, but they don't want to go much above that because they know demand is destroyed.
Well, we had the Trump tweet, didn't we? And this during the ceasefire saying, now, was it about oil prices? Let's just get it up. Yeah. Everyone will keep oil prices down. I'm watching. You're playing right into the hands of the enemy. Don't do it. This speaks to, what he's been saying to the Saudis in particular, right? You've helped essentially Russia in their war by keeping prices high, and they've been able to fund their war. So I think that seems to be the guilt trip he's put on OPEC, maybe.
Yes, but they have budgets that they need to satisfy.
But they seem, as you said, that band, they don't look like they're going for the $90 figure anymore. They're kind of happy 60 to 70 maybe.
And it's the supply-demand reality, right? We are in a tariff environment, in a poor economic situation.
Did you see, though, that Putin recently said he was happy with the objectivity and the depolitical attitude towards supply and demand outlooks and production. And he said he agreed with their assessment that demand was high and that oil should be, supplied at 105 odd million barrels. And he doesn't think he sees it decreasing. He was very clear about that. He agreed with that assessment. I mean, does that say anything to you?
Yeah, what it means is we will produce as much as we can.
Yeah. Yeah.
And everybody's pretty much doing that, right? And the market is still in the $60 to $75 range, and it's still a little bit backwardated. So that means that actually the demand is not that bad.
No, clearly, right?
And the only fear here is if we have wars. And I really think we need to take a little bit of stock on that. So far, in a period of 12 months, we have the Ukraine-Russia war ongoing, the Pakistan-India war, however short it was, and the Israel-Iranian war. These are a lot of negative events in a very compressed time period.
But I have heard, again, this is something maybe for the next podcast to look deeper into, which is that global stocks are building. And if they're building in a backwardated market, that also means and suggests that the market's been propped up, because it shouldn't be building whilst if it is that backwardated in the front.
Yeah.
But
that means they're not commercial, they're strategic stock build.
Or it could just be the derivative market is not reflecting the truth, right? I mean, oil traders positioning it one way, but the reality is another.
Yeah, I mean, China has been building inventories very steadily, and that would be strategic, right? They don't want to get caught short. The US also builds even if the market is backwardated. So you have the separation between commercial and strategic, and commercially the market is backwardated, so you shouldn't store anything, right?
Right. Okay, great. Right, we've still got a lot to run through. We'll try and do it quickly. So this is now the winners and the losers. Let's start with the gold rush. Okay, we had a spoiler alert, did we?
Spoiler alert, that was the winner maker. But gold rush we did touch on earlier about on the hedge fund watch. Okay. And our pick of the week would be the CTAs during the bullish run.
Yeah, you just said it wasn't, right? I think maybe the options traders, the guys with long options, long vol. We know the hedge fund was. We know people were buying a lot of volatility on the way up, and I think people did do quite well on that. Obviously, the market makers may not have done.
Maybe it depends on if there were a lot of people buying like $90 or $95.
But they were, right? It was building up very aggressively, and then it was building up before the crisis hit. So at 69, we were seeing a lot of call open interest growing, and then bang, you had the crisis. So people would have made a lot of money out of that volatility. I think that is the word around town. People did very well out of that. The only ones who didn't were the market makers who sold it. This is their job to warehouse volatility. And now that people are starting to sell volatility, they're probably like sighing a sigh of relief. And I think they're probably okay, the market makers. So I would say that's the gold rush.
Because both sides come out of it scot-free. I suppose, prior to the podcast, we thought it would be the CDAs, but perhaps after today's discussion, maybe they probably didn't do as well as we expected. Maybe it's just, as you mentioned, it was they made some money on the way up, but maybe they lost some money on the way down. They're a bit more slow to react.
Yeah.
But in a sense, they with this charts we see we had CTA net positions alongside price action in Brent. So you could make a case that they did do okay on the way up, which is what our argument was. The decisions were made before the market did a 180 last night.
That's fair enough. Okay.
But if we wanted a more niche one, I suppose that would be the naphtha crack, which came off in line with higher crude. So prices in the front month came off from like around -5 to -650-ish, and the market was already quite positioned short with open interest above the 5-year highs. So we did before, maybe there could have been some short covering flows, etc. But because of all of the market events, how these naphtha cracks are usually inversely correlated with Brent, the short market did quite well there.
I think you're right, because actually it wasn't just that. It was the fact that when Iran does get attacked, people are generally quite nervy about naphtha because of how much condensate the Iranians produce. And like that guy on Polymarket in the comments, he was sitting on a condensate tanker. And look, this is the thing. Fields and real production got taken offline in the condensate market and LPG. And LPG or propane did perform, but naphtha didn't. And actually, we thought the East-West would absolutely explode. It rallied, but nothing too crazy. And as you say, the short market, I would say they did very well because they should have really got destroyed on this move, but they didn't. You're absolutely right. And if anything, there's probably some profit taking going on now. And yeah, that's a good one on that niche one. But let's move now to the Widowmaker. So we spoiled alert already, but some irony because the gasoline versus heating oil is actually called the Widowmaker, right?
Yeah,
That's the Widowmaker contract.
it's yeah, there's quite a bit of irony here, but on this chart, EBOB versus gas oil. So very range bound over since the start of the year until June, until mid-June, where you see a boom, like the
then
differentials created.
Okay, so yeah, looking at this chart, let's look at the blue lines, M1, the performance of it, around 40 was the average, and then we were kind of rallying into June, right? And
Into
the
May,
market had
June,
been long that, the hedge funds been long. I think we had some huge trade houses long that as well, to be fair. And then, yeah, distillates tends to perform in wars. And yeah, I guess that's what it would have led to people wanting to stop out. And it just obviously it was mayhem and distillate. So it compressed considerably. I think the all-time lows, I don't know if it's minus 40, minus 50, but it really is like an extreme level when it's low. And I think when you gets to that kind of level, particularly for summer contracts, it kind of suggests that you want to produce gas oil over gasoline, which is completely seasonally the wrong way around, because obviously gasoline is when you get peak demand in the US, and distillates tends to be peak demand in like heating season. So yeah, it tends to never really, I think stats is like it never actually prices negative. So if you can get negative prices long, if you can get in there, it's a dicey ride. That's why I guess they call it the Widowmaker. But people do make a lot of money out of it. They lose a lot as well. So anyway, this time round, a Widowmaker, but I think people bought into these stop outs as well. And I don't know, it's a good position to have if you ask me, but you got to have strong mind for it. Okay, let's move on to looking forward quickly. This is the crystal ball. So Jorge, we just look at Brent, the Brent time spread, gas oil cracks, EBOB cracks, or gasoline cracks, basically up or down. So what do you think on Brent going forward?
Brent, ahead of the conflict, our expectation was that the market was tighter than people thought, and that there should be a recovery towards the mid 60, if not towards 70, but in that band. After the conflict, we got out of bounds, and we became mentally short. And now we're coming back down to where we should have been. So we are now kind of flat in the mid 60s. That's where the market really is balancing out between supply and demand right now. So we are in a golden period until the next crisis or the next punch up between the OPEC members. But I think the volatility around 65, 67 maybe even, will be fairly low for the next few weeks.
Does that mean you're bearish?
I am, right now, I would say I will be waiting
No,
for
you
the
have
next,
to say buy or sell.
at 68 sell, at 64 buy.
Okay. Vincent?
Sure. At these levels, we're currently Brent's at around 69.
Have you got the technical stuff yet?
Yeah, we do. So it's touching around some of the longer term moving averages. So down to the 100-day and the 20-day. So this is the level where CTAs might come in to sell. You have other momentum indicators which is showing that the bullish momentum is about to flip towards bearish. So I think we have a couple more dollars to the downside until 64, 65, where the market would find better support. So this time in Brent, I do concur with Jorge's view. So buy at 65, couple more dollars down.
Yeah, I think I'm more in the camp of long-term bearish. I think that's how the market wants to position. I think bulls have been completely taken out. If they have been bullish, And again, it's that market resilience, right? If it doesn't rally in those kind of scenarios sustainably, it's quite hard to be bullish long term. I think people are generally still think we're calling for like 50-ish by the end of the year, depending on how bearish you are, and OPEC supply coming more and more online. I don't know if you agree with that, Jorge, but generally speaking, I'm going to take the bearish side. And then the cracks, again, like for me, they're too high, right? The margins, I'm constantly going to think that's just too high. And I think the front Brent spread as well has had its time. And as you see, everyone's got to offload things. So I'm kind of bearish across the board from here. I don't know if you agree.
Well, politically, we have the tariff wars still rattling the cage. And that could impact diesel demand because there are fewer things to truck. And I think that's going to be the narrative over the next 3 months. So I would say that the whole complex over 70, as in the discussions we had, was a sell. But the market has been and is tight in the summertime because of the summer burn. That continues for 2 more months. And then we will see what efforts Europe and the US do to prop up their economies. That is unforecastable. But I think they're going to do something, release more money, print more things, have some type of QE. When you have QE, that's market supported. It doesn't mean that things are going up just on a numerical basis. They're going up because there's more money. So I expect the US and Europe to go into cash release by Q3. And that changes that oil price scenario.
Okay. I think, go on.
Yeah, I guess that's a future herd mentality topic then.
Yeah. All right. Thanks, guys. A lot of detail in there. Thanks very much for listening. As always, please like and subscribe and forward to people who might be interested. And see you again next week.